Every great investment you've ever made started with the right connections. Connections to the world's most sought-after investment community, dedicated to improving business and society. You are part of this community. Welcome to iConnections Global Alternatives Conference. In 8 short months, managers and allocators who control a combined $60 trillion in assets have used our platform. But as you know, there's more to our story. Funds for Food was the largest capital introduction conference of 2020, facilitating over 3,000 meetings with the industry's most sophisticated investors, while also raising nearly $2 million supporting those in need during the pandemic. We followed this with Fund Women Week, the largest capital introductions conference in 100 Women in Finance's history. Initiatives like these are at the heart of iConnections' mission. In early 2022, we will combine the latest in virtual and in-person participation at the world-famous Fontainebleau Hotel Miami. You are part of this community because you are the people with the vision to improve society. Invest in progress. Welcome to the world of iConnections.
Hello everyone, I'm Ron Biscardi, the CEO of iConnections. I'd like to thank all of you for participating in this year's Global Alternatives Conference. This is our first year hosting this event, and of course, it's virtual. But we are looking forward to our first in-person Global Alts event, which will be held at the Fontainebleau Hotel in Miami Beach during Hedge Fund Week in January 2022. This event will feature world-class content prepared by the iConnections Investment Institute, followed by 2 days of one-on-one capital introduction meetings, which we project will number over 10,000. This event will be free for allocators and open to managers who are members of the iConnections platform. So if you're not already a member, please go to iConnections.io to learn more. Thank you for joining us, and stay safe and healthy.
We've all heard the quote from Einstein, the definition of insanity is doing the same thing over and over again, but expecting different results. According to our next guest, this is, quote, exactly what we do in investing and exactly what we should do. He's been named one of the 50 most influential people in global finance by Bloomberg, is the 5-time winner of the Bernstein-Fabozzi Jacobs-Levy Award, a 2-time winner of the Graham and Dodd Award, and received the James R. Verton Award from the CFA Institute in recognition of his lifetime contribution to research. Today, he's the founder, managing principal, and chief investment officer at AQR Capital Management, but he first studied and then assisted Eugene Fama at the University of Chicago. After several years facing turbulent markets and navigating the effects of the pandemic on the global economy, it's never been a better time to discuss the benefits of value and playing the long game. Please enjoy our Keynote Fireside chat with Cliff Asness.
Hey, Cliff. Great to be here with you.
You too, Ted. I'm excited.
I thought it might be fun, given everything that's happened, to circle back and ask you, what were you like as a kid?
Let me see. Let's say kid is pre-college. I would say pre-college, I was a wise ass. Post-college also, but certainly as a kid, I was not super motivated. When it came to academics, I had okay high school grades, but nothing to write. I was a kid. My parents had a lot of meetings about my underachievement, and then I got lucky by standardized testing. I did very well on the standardized tests, and there are a number of people who were like, you really should try. And then I got to college, and I did have a bit of a panic moment. I admit, a panic moment, meaning a couple of months of, I've been telling everyone for years that when it really counted, I would actually try, and now I'm here, and what if I fail? So pretty much, I was a slacker until college, and ever since college, I've been whatever the opposite is. Not that I work super hard, but type A. I went from type B to type A in a weird kind of way that I've never really fully understood.
And at what
Sorry,
point,
more than you probably wanted it to know.
well, it all gets interesting. So at what point in time did you gravitate towards quantitative methods and interest in investing?
Sure. The program I went to as an undergrad was a dual degree program between an engineering school and a business school. That, looking back, there seems to be some foresight to that. There wasn't much, and if there was, it was on my father's side. Again, I barely pursued what college to go to. He found this program somewhere and said something like, well, you like math and you don't know what you want to do, so study two things. So there was not any grand plan to apply engineering, quantitative, computer science methods to finance. Though I did end up, somewhat in the perfect program, I think, for what I ended up doing. And then even when I was in that program, all through college, I assumed I'd be an attorney. I come from a family of not all, but a lot of attorneys. I assumed I'd be on the more technical side. And it was my father again. He chimed in at one point and he said, first of all, I hate being an attorney. I'm not casting aspersions on attorneys everywhere. My dad was a criminal trial attorney, both assistant district attorney and then a defense attorney in Manhattan. And he just didn't enjoy that life. And he's like, and every attorney I know, which is, again, I don't mean to demean attorneys, I'm sure it's not true, can't do math and you can. So it seems like a bit of a waste. And by dumb luck in college, I did this purely for money because I needed money. I was a research assistant, a computer programmer for a few finance professors. One of the three is actually Andrew Lowe at MIT. He ended up writing one of my recommendations to Chicago. And I really, not that I understood it all, but I could tell I liked what they were studying. It fit my kind of aesthetic combination. Nothing great, logic beyond that, but using quantitative methods, computer science skills to try to answer or at least address real questions in investing and other aspects of finance. And at some point, I said to one of them, I don't remember if it was Andy, how does somebody do what you do? Which is kind of a stupid question looking back. It's pretty obvious. But they're like, you apply to a PhD program, blah, blah, blah. So without a ton of thought, I switched. I was actually registered to take the LSATs, and I switched to the GMATs because that's what PhD programs in finance wanted. Then I had other kind of fun things with this. I was an undergrad at Wharton, and I went around to maybe 10 professors, a couple of which I knew, but most were just office hours. I'm a student. I'm thinking about being an academic. Where should I go? And this is more than 30 years ago. So the Wharton PhD program, nothing about it today. But at that point, I naively assumed, well, I'm at Wharton. It's among the best business schools. I stay here. I like it here. And literally to a man, there was one exception, but it wasn't in favor of Wharton. Like 9 out of 10 professors first said, close the door, because when they're going to tell you to go somewhere else, it's a little disloyal to the school. So that was almost ubiquitous. And then 9 of them said Chicago. One said Stanford. That was Robert Litzenberger, wonderful man, Stanford professor, more of a theoretician. So I ended up going to Chicago. I wish I could look back on these choices. It doesn't feel like it the last few years, but I think they have worked out. And say there was some great plan behind it. But I had a few guiding lights. My dad was very helpful, trying to find a place where this confluence of skills would be useful, going after something I was interested in. I mean, I actually liked the work the professors were doing, but there was very far from a grand plan of, I'll do this, and this will teach me how to make empirical statements about stock returns. And then I'll go to Goldman Sachs, and then we'll start our own. No, it was, whenever you talk about your own life story, particularly if you're going to claim true or falsely that it ended up well. I shouldn't say ended up. It's not done yet. you probably should acknowledge some pretty massive role of luck. There is nobody out there who is successful who doesn't have some massive role of luck. That can be, for me, all these different decisions were lucky. And being at Chicago in the late 80s, when Fama and French were not doing the only work, but doing at least subsequently, and even at the time, the most well-known work on the early versions of what we now call kind of quantitative factor investing. Like almost anything else new, you forget that nobody used these terms back then. It's like they become the terms later, and then you refer. But then when you talk about the past, it feels a little odd to use terms you weren't using then. But being right place at the right time, being there while this was going on, and anything that the kind of two of Fama being the absolute Chicago star and French being a rising star, anything those two guys were doing became something every PhD student wanted to do some aspect of. So that was dumb luck.
I want to circle back to a time, probably one of maybe the last couple of years has been the third that you may not have felt so lucky, which was the early years.
I knew we would get there.
The early years of launching AQR, and
Sure.
Just to talk about a little bit of the parallels of how that felt and how you've been feeling the last couple of years.
Sure. I mean, I've been doing this. First academic evidence I studied was in 1989. I've been trading these things since 94. Again, I'll mildly brag before big mea culpas. It's networked out, but we've had at least 3 really tough periods. The first one was still, the current one is this will sound odd, Ted, but when myself and some of my co-founding partners get together, occasionally we will get into these morbid debates about which one of these episodes hurt most, which one was the hardest to live through, which was, and there's an argument, something early in your career is extremely dangerous because beginnings are important, and frankly, you haven't built something yet to withstand something, and your personal finances are nothing to write home about. So you probably face the most existential risk when you have a tough period in the beginning. A tough period later on, you're responsible for a lot more people, a lot more clients. And if you're the kind of person who I hope we all are, who care a lot about that, it has a very different aspect. It's not about your personal success. It's about your responsibilities. But we had a wonderful run at Goldman Sachs. Factor investing, the early versions, again, no one used the word, but it was a great period for what we did. We went to launch our own firm. We left at the end of 97, and we launched our first product in August of 1998. There will be some people on this call who will remember, but fewer and fewer, that was the month Russia defaulted and long-term capital began its 3-month descent into the abyss. We were very excited in August, not that we wanted someone else to suffer, but the S&P was down like 22%. Don't hold me to the precise number. I should say 20 when I don't really remember, but it was gigantic. I always refer to this as the crash nobody remembers. It was the crash of 87. It just happened over a month, not in a day. And a day gets the headlines in the papers more than a month. And we had a pretty decent up month in August. So there are kind of high fives all around. There's, we don't want the world to end. We're not rooting for competitors' demise, but it's exciting to protect our clients in such a tough month in our first month. We also had never suffered any adversity at Goldman. So we just thought this is how it works. We win. Lather, rinse, repeat. Then the next 18 months savaged us. We were on the wrong side. And I think this period, it's a cliche, but history doesn't repeat, but it does rhyme. There are some big differences between today and the tech bubble, but there are some giant similarities. We ran teeth first into the tech bubble. We knew it then. We know it today. That I might if we get into it, I might define these terms more later. But if value investing, as quants define it, price to fundamentals, does poorly, we can still do well if it's doing poorly on the fundamental reasons. There's a lot in our process, quality, momentum, fundamental momentum, low risk investing, that can really help you if value is losing for rational reasons. We've never found anything but pure price momentum. And there's a limit to how much of that anyone, I think, should have in a process. It has some pretty bad left tail properties if you let it dominate what you do. But aside from that, I've not really found anything that is really good in a irrational loss for value, where it's not really losing on the fundamentals. It's just there's a, I'm enough of a Gene Fama student. I feel guilty every time I use the word bubble. But when there's something bubble-ish going on, that's a tough period for us. And the reason, of course, is value suffers, often even worse than when it has rational reasons, which is odd. And the quality factors, the earnings momentum, that's not what the market's trading on. Value's not doing worse fundamentally. And that's what we lived through for our first 18 months. We originally launched a pure aggressive hedge fund product, taking more than 20% volatility, attempting to be market neutral. There's a little story there. When we went to start our own, at Goldman Sachs, we always did very traditional, beat the benchmark investing and market neutral, long, short. You can call that hedge fund investing using the same process. Just, if I'm going to oversimplify, but if you like A and don't like B, and you're managing against an index, you own more than the index of A and less of the index of B. If you're running a market neutral portfolio, you're long A and short B. So there's, they're not perfectly in line, but in general, if your process isn't working, you're both underperforming a benchmark and we don't do this. I'm saying it's for real diversification. We do it to have a broad business, to do what our clients want. But the first thing we launched was a very aggressive market neutral hedge fund with at least value as a big part of what it did. That was not a fun recipe from late 98 through early 2000. And ironically, we wanted to do traditional investing also, which again would have suffered against the benchmark, but 22% vol, a -2 standard deviation event at that, without the market, which was going up to at least hide some sins, which it does. It was a tough way to do it, but we found early on you could not raise money for traditional. We were 30-something people looking much younger than I look today, and people said, come back in 5 years if you want to run our traditional, beat the benchmark money. But, and I say this with some irony, if you have a hot new hedge fund and you say to them, we're the same people, but we're going to charge you a lot more, take a ton of risk, we're going to lever a lot, and we're closing. They go, oh, okay. That was just the path of least resistance. We ended up building both businesses, but ex post, I'm sorry, I keep going on, but this was just an error that we, and particularly I, made. Even launching a pure hedge fund product, a lot of our initial investors said, we don't need 20+% annual vol, trying to get, high double, even triple digit years when it really hits, something more sedate. And to every one of them, I said, if you want a quarter to the aggression, give us a quarter to the money. To this day, this is 23 years later, I do not admit my math was wrong. If you give someone a third of the money, you have a third the downside. By the way, as I love to point out, it's completely fair. You get a third the fee. It's one of the few things where you can't ever be cheated on that. You give a third the money, you have a third at risk, you pay a third the fee. Of course, I missed the entire point. Down 20+% at 2 standard deviations. We weren't actually quite down 40, but call that down 40% against what you expect. That's still a 2 standard deviation event. That's a dime a dozen in finance. It is not a dime a dozen when you are the low man on every totem pole at every portfolio review. I had a little bit of a geek, come to Fama moment where it was, the rest of the world doesn't always think of these things in risk-adjusted returns. And that should not have been a shock to me. The idea that if you lose 40%, it's worse than losing 10% would not strike most of the world as a particularly difficult concept. I had to learn it. So The event was really bad in the beginning, but not shockingly off the charts bad, but we made it so with our kind of initial firm design.
One of the things you're touching on is this calibration of expectations. And there's always this notion that you really can only be wrong for so long before people get antsy. Yeah. I'd love to ask, as you think of AQR today, right? We know that value's been in the tank. We know that quantitative investing has had tough times. What do you see as the brand of AQR?
Anytime I talk about us in generalities, I feel like I'm both bragging and saying these highfalutin things that people will roll their eyes at. But I do think intellectual honesty has always been high on my list. If we're wrong about something, I think people are way too afraid in this business to say they were wrong about something. I think when things are not working, and even when they are working, sometimes you want to do this even more when they are working, because what you're doing is maybe getting over popular. We really do spend a ton of time trying to figure out the age-old cliche but relevant question: is it ever going to work again, or is the world now completely different? We share that research with our clients. So great research and intellectual honesty, let me put it more humbly, is at least what I would like the brand to be. I think for many people we do fulfill that, but I won't put words into the whole world's mouth. But if I had to choose a non-poetic tagline, it would be those two attributes.
So as that translates in the product, we know it's been a rough time. Let's just start with value. What is the case for value today?
Okay, there are two cases for value today. There's the case for value at any time, the long-term case, and you have to work at, does this case still apply, right? Even if at a time when I wasn't telling you value is super distressed and the cheap are super cheap against the expensive, even at a normal time where these things are average, we like value. So at the very beginning, I start with it is not a pure conditional tactical case now, though that aspect is part of it. So there, you have to go back to your drawing board and say, all right, what evidence do we have that this works? And the evidence that it has worked. Let me get my tenses right. We get our tenses wrong in finance all the time. We say something works when we mean it has worked, and we hope it works going forward. But first of all, data is not going to change sadly, actually, because we'd love to be told in 5 years, it's time to stop doing this. But even a terrible few years is not going to change between 30 to 200 years of evidence across geographies and asset classes of any kind of reasonable value measure you want on average working. So if you're waiting to say, well, it's been, for quant in general, it's been a terrible 3 years, call it. For value, it's been a terrible decade. Those are not the same. We and a lot of other quants did not really, actually, we didn't just not suffer, we prospered in the first kind of 7 years of value doing poorly. And that gets back to the rational loss for value versus irrational loss. But even that amount of data is not going to move the dial very much at all on your long-term evidence. So arguments for whether something is different now going forward have to be based on something else. And let me give you an example. We have been obsessed since 1999 in tracking something. We don't trade it very actively. I've talked about we only do things at what we think are giant extremes, and then we only take small positions. We don't believe much in timing these things, but we track the spread between cheap and expensive. If you're a quant value manager, I will distinguish that from a more general value manager, an active manager who might use value in a different sense. Like when a quant says it, they just mean price against fundamentals. It's not weighing it against other positive characteristics. Of course, you should pay more for some companies than others, and quants try to get at that in some other ways, other factors. But I'm segueing here, but that's a giant source of miscommunication between traditional active managers and quants. Somehow, I think poorly, the academic and practitioner world labeled price to whatever fundamental you like as a factor, value. when it's really low price. It's scaled by a fundamental, but it's not value. I'm going to go back to calling it value because everyone does in my world. But if something is worth it, it's worth it. A true value is a broader sense. But I think because quants call their factor value, there's often this kind of fight where traditional managers go, you guys think value is just price. And we're like, no, we just get at it through multiple ways. So evidence is not going to prove you're wrong. Returns are not going to prove you're wrong. What other evidence could there be? Well, for years, we started doing this in 1999 in round one of defend your life. Value's doing terrible. Should you stick with it? And we showed in 1999 that the spread between cheap and expensive companies in the quant naive fashion averages, call it here. With Zoom, I talk with my hands a lot. I'm still trying to figure out how to do it on Zoom. Averages here, but it moves through time. Sometimes the expensive are much more expensive than the cheap. Sometimes they're far cheaper. Sometimes they're much less expensive. They're always more expensive. It's your own measure. If you sort stocks on your own measure, you better be able to find that the more expensive are in fact more expensive. But the amount varies actually a fair amount. So in 99, much like today, we found these numbers were kind of off the charts. I guess considering it's about tied with 99, it's not off the charts. It's back at the peak of the charts. What would really give us pause? Well, one question we get a lot during any bad period for value is it not working because everyone has figured it out? Too many people like you have the positions on and they've arbitraged it away. Well, I think we kind of know what arbitraging away looks like. It looks like the opposite of early 2000 or today, where differences are extremely wide. Arbitrage away would be a process of people like me and non-quants can arbitrage it away too, which is people seeking value, bid up the cheap companies and sell off the expensive ones, such that the spread between cheap and expensive is considerably narrower than history. If we saw literally the opposite environment of today, if normally whatever multiple you want, the expensive were 5 times more expensive, and the historical range was 3 to 8, but now they were 1.5 times more expensive, you really have a gut check. You'd have to say, well, God did not ordain as in Exodus that you get a value premium. If you believe the behavioral stories, you believe people pay a little too much for the darlings, a little too little for what they're pessimistic on. They're not wrong usually in direction. The companies that you're paying more for generally deserve it, but markets extrapolate a little too far. They think they know the future forever. And if they stop doing that for whatever reason, I like to say they can stop doing that because the demand or supply for investor error changes. That's an obnoxious way to put it because investor error is kind of cruel, but the supply of error is that irrationality I talked about. If the world awakened one day and every investor was perfectly rational, every value manager I know, certainly including myself, is a hypocrite. When we lose money on value, we get really mad and we start saying how dumb the world is and whatnot. And do you believe this craziness? And yet, if you said to us, do you want a perfectly rational world? Most of us, a few believe, like my ex-professors are more proponents of the risk-based explanation, but most of us believe it's a behavioral story, or at least a big part of it. So behavioral stories are someone else making an error and you helping fix market prices and making a profit from that. So if someone said, do you want a perfectly rational world? If we're paying any attention, we'd scream, hell no. So what every value manager wants, any way you define value, is these great opportunities that come from somebody else not getting it perfectly right. But as soon as you put the position on, all the people you're trading against, about 3 hours after you put the position on, go, oh, obviously AQR is right, and you make money every day. And it doesn't work that way. If this is behavioral, sometimes, by definition, once you say things aren't perfectly rational, saying how irrational they can get, I don't know any theory that caps it. So, long-winded, I went into a bunch of other topics, but there are other things. Trading costs are one of them. If they went through the roof, I think you might have to say many viable strategies would have to be less viable going forward. But for me in particular, if we ever see these spreads between cheap and expensive really tighten up past normal history and then stay there for a while, I think we might have to say either investors have wisened up or too many people are doing it. But there simply is no value premium anymore. To have a value premium, you need a difference in valuations. Again, we see the opposite today.
So to the extent that the value factor underlying it is a behavioral phenomenon, I'm curious how you thought about in your own process at AQR rebuffing the potential for confirmation bias and the other behavioral flaws that lead you to just keep going down the same path if in fact things are changing.
Yeah, there's a whole physician heal thyself for behavioralists. I've joked a lot of people who believe in behavioral finance or behavioral economics or even behavioral psychology are very far from immune. You would think I'm actually fond of saying, I got to be high on the list of people who are at least supposed to understand these behavioral phenomenon, and yet I'm subject to every one. I've written recent pieces about how I throw things around my office and decide that 200 years of research is wrong, and we are particularly bad at what we do. It's not just that and the only cure for that. Everyone at AQR panics when I say that, and it's another one of these. You got to be careful these days, and I'm not always the most careful person. But I love to turn it around and go, do you really want a manager going through a tough period who doesn't occasionally wake up and think they might suck? Who just says, no, I'm right, it's going to work, blank you. So, in some sense, as long as you don't let emotion drive your portfolio decisions, and I think we're really good about that. I might have a really bad day some days, but if you're invested with us, I hope for better, but for better or worse, that bad day does not affect your portfolio, but it does kind of drive me and others at AQR too, but me in particular, I'm thinking about now to re-examine everything. If you are confident yet filled with self-doubt, you should be confident about what you do, or you shouldn't do it. But if you're not occasionally filled with self-doubt, particularly when you're responsible for a lot of people and it's going through a bad time, then again, I don't know what the alternative to that is. But it certainly, speaking deeply personally, drives that kind of temporary self-doubt that could become permanent if I discovered a reason for it, drives me. There have to be at least 10 times where I think with an open mind, again, you have confirmation bias, nobody is perfect, tried to reprove to myself the thesis, both for the general idea of factors and our particular implementation. I look at the long-term evidence. I look at our long-term evidence of doing this. I look at, first principles. Does this still make sense? Is there economics, or did we overestimate the economic logic when it was working? And so far, and I've written a ton about this, I share a lot of my kind of, not just the emotion, but the specific tests. What if this is going on? How do you look for it? Some things are not testable, but many are. So there is no magic bullet. Everyone has confirmation bias. Recognizing it, taking whatever emotion, which is a different kind of bias you have, and channeling that towards something productive. All right, if you're filled with rage and self-doubt and a bad day, don't just sit there and yell. Go check everything again and see if you still think you're right. That's what gets me going.
So in recent weeks, you've written a piece that reviewed the case for value, and we've also seen pieces by Jeremy Grantham and Howard Marks, and the two of those had very different perspectives. Like, as we've talked about, Jeremy effectively, value will come home to roost, and lots of bad things will happen. Howard talking to his son, rethinking the definition of what value means. And I'd love to hear your perspective on their two research pieces.
Well, obviously they're both brilliant people. I read what they write, which doesn't mean I always have the exact same perspective. This will shock no one listening to this call, but I'm probably closer to Jeremy on this one. We've certainly disagreed about things over time. Jeremy, I think, I don't want to get it wrong, but is a little more of a little more value than I am. long term. Once a decade, I become super value guy when I have to defend it. But again, we can go through long periods where the other things are working. I teased GMO a bit because I found their paper to be excellent, and I said largely because it looks a lot like the one I just wrote, which is obnoxious. And I shouldn't even tease them because you need multiple voices. If you think something is true, you always want to be the person to tell the world. But it's amazing how echo chambers, hopefully they're echo chambers with some thought, not just echoes, but repetition counts. And both Jeremy's paper and ours looked at a lot of the many arguments for why now is different. And some of this relates to Howard's work. For instance, the companies that perhaps, and I say perhaps, can grow for more and for longer and for steadier than any in the past. We've seen some of that occur, of course. But of course, life is always about going forward. So let's assume that's more of a chance going forward. What we did, and then what GMO did a version of, is, all right, let's try everything we can in our abilities to throw those companies out. You can't just throw out the ones today, because then it's not an apples to apples exercise, because you're not throwing out similar companies in the past. So in our version, and again, Jeremy did some fairly similar things, we said, all right, what can we throw out? Let's throw out industries, first of all. Industry classifications are not perfect, but they capture some of it. So we threw out, using SIC codes, tech, and then tech, media, and telecom all together. We threw out mega caps, which covers all the FANGs, FAMANGs, FATANGs, whatever version you like. They're all gone today. We threw out the most expensive, 5 or 10% of the stocks, and said, all right, imagine you're a value manager not allowed to trade those. And what we discovered, and the GMO work jives very well with ours, is value had still done just about as terrible, and the spreads between cheap and expensive in what's left after you throw this out, and comparing it to that same exercise in history. Of course, the spreads are lower today. If you throw out the most expensive stocks, the spreads between what's left and the cheapest will be lower, but they're always lower. The comparison to history put us at very similar standard deviation events, percentiles. And I think both GMOs and our point there is all the stories you hear may be poster children for what's going on, but they are not the broad, diversified loss to value. It is deeper. We may have 5 stories out there for companies that nobody should trade on valuation right now, that have long-term futures that, again, you can be optimistic or cynical about how easy it is to predict which companies they are. I'm gonna suspend my disbelief and say there are these companies. It's not a big part of what's going on in value, and it's not a big part of the misvaluation now. Another thing both we and GMO did was look trying to do value within each industry segment. So imagine there are 50 industries. Basically, you have 50 value strategies instead of one. You're not allowing a bet between tech and textiles. Again, industry classifications aren't perfect, but if anything, doing that lowered the value dispersions back in the tech bubble. This should surprise no one. There's a reason we called it a tech bubble. It was a little bit more about industries. Comparison to history, it's not about industries today. You go through, it's much closer to, physics envy is all through finance, and I'm going to mangle a physics analogy, but this whole idea of an expanding universe, getting your mind around what that means. People use the analogy of a balloon, that we're on the, two-dimensional, we all live on the surface of a balloon and it's expanding. So everything is moving away from everything else. Which is kind of hard to get in your head. You always think of a center point. For valuation, it's not a perfect analogy, but it's everything stretching out. It is not, again, the poster children might deservedly be the poster children. You don't have to bet a lot on those. It has not been the major source of your losses. Again, I shouldn't say that. If you're an active manager whose big position was short Tesla for the last 5 years, Ex ante, maybe you were right or wrong. Ex post, it is the major source. For diversified quantitative investors, it's the everything going on. So GMO and NAQR came to very similar conclusions on that. I will say, you said Jeremy is more of a doom and gloomer. I don't quite have that same kind of, I think it's going to be very good for value going forward. I don't think the world has to come to an end. The tech bubble coming down, it was a mild recession, but nothing like the GFC or certainly what we just saw. An equity bubble coming down the world seems to be more robust to that than debt bubbles. Certainly, pandemics are entirely different things. So I don't necessarily think a return to value or value finally having a positive return, if I can use that word two ways, ushers in doom for the world. And there's a little bit of maybe personality difference. I think Jeremy's a little bit more, and he's been right about it sometimes, so you can't take that away. Now, Howard is always brilliant, but writes always from the perspective of a brilliant, active manager who knows a ton about every position. Broadly speaking, active managers have huge advantages over quants in that they can learn everything about a position. Quants have huge advantages. We don't have to know everything about every position. If the overall phenomenon works, if valuation cheap valuation is rewarded, you can be right with a concentrated position, or you can miss it because your position didn't work out. So we are playing more of a statistical game, even if the philosophies are similar. And that does lead to maybe a difference in perspective. Howard's piece made the point that I was making earlier that I absolutely agree with, that value is not just price to fundamentals. Some companies are worth it. Where we maybe differ a bit, and this wasn't even his focus, I won't even say we differ, it just wasn't something he addressed, is I think the quantitative world covers that too. We just cover it a different way. We happen semantically not to call it the value factor, which I think was an error again. I think we should have called, price to earnings, price to cash flow, price to book, the price factor, and called value the whole thing. And then we'd be much more congruent with how people like Howard think of it. But I think that difference is more semantic than real. Howard also had a great thing. I love the way he used his son. My children are a little young for giving me stock picks, but I do notice they spend more time on TikTok than going to the gas station to fill up cars. So I get a little bit of tech from them. But there again, I think there's a big difference. Howard's saying there are a few companies, and I remember I caved on this earlier. There may be a few companies that are predictably going to grow. I caved on. I say maybe. The world could still end up being surprised. We still have a competitive world, and even those companies may have growth rates that are hard to sustain. It's always hard to imagine the next competitor. It always seems like a unassailable monopoly. But we thought that 10 years ago about a few of the early companies. They're more entrenched now. But for this purpose, I'll cave on that. There are a handful of companies you can predict that. Where I don't even know if I disagree because it's not what Howard's talking about. But our work and GMO's work says that may very well be true, but it is not really what systematic value, as the quants describe it, is doing. We're less at odds than it seems. You'd be crazy to use a quantitative process to go short the 5 most expensive stocks. They might all be worth it. One of them might be worth it so much that it doesn't matter. You obliterated yourself with that. Concentration is not what you go to a quant for. So I do think ultimately, and this is not a shock, I'm bragging here because I respect Howard so much. I think we are actually saying fairly similar things, but we're just saying them in very different ways as fits where we come from. Yeah. He's a brilliant active manager and I'm a mediocre quant.
So let's turn a little bit. We've been talking about the value factor, maybe better stated, the price factor, to what you
I'm not going to win that battle, Ted.
That's okay. We could still try. It's semantics. Okay. The last 3 years, you mentioned that value went from rational value to irrational value, or, quant has really struggled. So what's different with quant investing and the challenges of quant investing compared to what we've been talking about mostly with the value factor?
Sure. Well, a few things. I will talk about quant, though we were just looking at this yesterday. We knew this anecdotally. We just got some data. It's pretty much as bad for traditional active managers who really define themselves as value. So I have a quant lens I look through, but it's not like that real value-based stock pickers are having a good time the last 3 to 10 years. But what's different is it does get back to this idea that value is not just price. I'm going to be really rough here. These are not a detailed full model, but value might be 35% of how you choose a stock. Quality might be another 30%. Momentum might be another 25%. Estimates of risk, trying to buy low risk investments. That doesn't cover everything. I'm not getting it all. I'm short selling the models a bit here, but imagine that. Well, if value is maybe a plurality, and I'm speaking for us, I think it is a plurality, but I don't know that about everyone. If value is a plurality, yeah, you don't want value to do poorly, but a plurality is not a majority. So if value has a tough period, but the other things have a really good period, better than value was bad, you will have a good, perhaps even a really good period. And that is much of what we saw for about 7 years. The value drought is roughly, again, if you measure value at price to book and I do it with price to cash flow, we're going to get a little bit different on our end dates and whatnot. But call it from 2010 to the present, value has been some degree of terrible. Up until about the end of 2017, these other aspects, and this is probably true for non-quants too, who look for a more holistic approach. These other aspects helped a ton. And, frankly, pride goes before a fall. You should never be too proud in this business, but we were kind of proud that we did well in a poor period for value. We thought that was interesting. At the end of 2017, the spread between cheap and expensive companies, I'm doing that thing with my hands again. The spread between cheap and expensive companies, even though value was pretty horrible for 7 years, wasn't particularly out of line. This is hard to believe given how much I talk about value these days, but in 2017, go on our website, my section in the blog, I am literally taking the other side of people saying, you got to swoop into value and do more value now because it's done terribly. And it wasn't very complicated. It wasn't genius on my part. I said, well, it's done terribly, but it's done terribly because the fundamentals have done terribly. If you bought a stock because it has a low PE, not a good single reason to buy a single stock, but if you bought a stock because it has a low PE and the price fell by 50%, maybe most of the time it got cheaper. But if the earnings fell by 75% on your measure, it got doubly as expensive. Nothing was that extreme, but the fundamentals justified much of value's loss. Therefore, price to those fundamentals, there was a loss, but the fundamentals moved against it. So the valuation spreads didn't do this. I didn't say abandon value. I wish I did, just to say get back in 6 weeks ago. But I said, no, it's not a time to do more. It's not cheap. It is simply lost. The last 3 years, I've obviously changed my tune. The last 3 years, we've seen value continue to lose. Two things that go together happen. These are the same phenomenon. The other factors that can catch a rational loss for value, I won't say they haven't helped. I think they've helped a little, but not nearly enough because it was an irrational loss for value, in my view. I should say that's opinion. And we've seen an explosion in the spread between cheap and expensive. Because when it's not the fundamentals driving it, it's just price driving it. And then you see that valuations gap out. So I think it is an unpleasant story in the last 3 years, but it's still not a terrible story over 10 years, and it's a very consistent one. The pure price factor has done badly this entire time. I think it did badly. I'm overusing this word. Nothing is perfectly rational or horribly irrational, but it did badly for what I will broadly call rational reasons up until the last 2-3 years. And again, this is not a quant observation. I have no great evidence or insight in this, but it certainly feels like a rational loss for 7 years has led to a lot of chasing and a blow off bigger than I would have expected. I think COVID is what kicked it up to be bigger than even I would have thought would occur. But I think we have a blow-off irrational top following a fairly rational loss for value for quite a while.
Well, we were talking earlier about factors catching up and what you would expect to see on the price. I'm curious about the other side, which you just talked about, the fundamentals. Was it anomalous that the fundamentals of the value businesses did worse than the growth businesses over that 7 or maybe now 10-year stretch?
There are multiple layers to that question. First of all, it's always worse versus expectations. On average, the fundamentals of cheap companies, cheap being the quant definition, not the holistic definition, are worse. And on average, the market might not be perfect, but it's not nuts either. The prospects are worse. When the market price is selling to a low valuation, there are some exceptions. The peak of the tech bubble, unlike today, there's some good parts about being a value investor today going forward. You don't have to take a very big industry bet. It's more diversified. One of the best parts of the tech bubble is you did see that very rare confluence of these super cheap companies being higher quality companies than the super expensive one. The ones that are super expensive today are not pets.com. They are real amazing companies. So, I think it's 6 to 1, half dozen the other, which one you'd prefer to be going forward. You didn't enjoy either of them while they were happening. But basically, I do think value loses on average on the fundamentals. When I say it had a bad 7 years, it means it lost by more than what was priced in. It is anomalous in the sense that value, I believe, works because over the very long term, it loses by less than what's priced in. Right. It doesn't use, again, aside from rare times, it doesn't usually win on the fundamentals, but we all know investing is about both price and performance. If you lose by less than what was priced in, you win as those investors. As to this occurring for 7 years, as to how anomalous it is, again, we can all define it different ways, but it is shockingly kind of not off the charts. It's kind of a 2 standard deviation bad decade. It is not a 10 standard deviation bad decade. Single strategies, like what I call price to fundamentals or the quant world calls value, have fairly low Sharpe ratios. You don't have a giant edge. It is part of a process. And so, if I'm gonna make up a number just because I can only handle round numbers as I get older. 0.5 Sharpe ratio to lose money over a decade, not to just be below 0 over a decade, needs a 1.5 standard deviation event. Once you get to 3 standard deviations, and in finance, everything is fat-tailed. We generally like to talk about 3s, not 2s. Some things short-term can be much fatter-tailed than that, but 2 to 3 standard deviation events is a significant loss for value over 10 years, and you absolutely expect it occasionally. The theory says, on average, over the long term, cheap companies are too cheap. It doesn't say they always are. Yeah. I think they are now. I didn't think that till starting about 3 years ago.
So one of the challenges when you go through this period of time is this classic case of needing to manage a business through it. Clients don't like losing money for in relative or absolute basis over time.
I've never found that, Ted. I find clients really enjoy the losses.
What's been the worst client interaction you've had over the last couple of years?
Okay, I'm not going to name names. It wasn't in this country. It was really a weird meeting, and it went on and on. I got to say, this is not just puffery. Most of the interactions are really good. For one thing, I've discovered very early on in the tech bubble, we had more of a hedge fund model, so we had a lot of locked up investors. I think when you take north of 20% vol, it's useful to know that capital won't flee. I won't necessarily apologize for that, but we make much less use of those, only if something is a significant, giant amount of a fund where we want to make sure someone doesn't just leave all at once. And I do find when you lock up investors and they hate you, right or wrong, sometimes people are hated for good reasons. Sometimes they're hated just because, the performance is terrible and they can't leave. Then you have really terrible meetings. because humans extract their revenge in different ways. If they can't leave, you will have a terrible meeting instead. Nowadays, almost everything we do is open. So you certainly have meetings where people are challenging. But at the end of the day, I believe in this. I've been adding money to this. Do what, here's our case. And, temper stay very low when it's kind of in that situation. But I had one meeting that was a throwback to the lockup. It was not a locked up investor, but it kind of was, and I'll explain. We had about an hour and a half meeting where the guy was upset that we were going through a pretty bad period. He was in one of the more aggressive. We don't do 20+% unless someone signs like 9 waivers and swears to God they get it. We don't want to run that kind of vol anymore. But it was aggressive, fun, market neutral. So in a world where the market's going up, by design, a market neutral investment gets no benefit from that. So if you have a relatively poor period, you're losing money as opposed to just not keeping up with the market. To a statistician, those might be precisely the same thing. They are not the same thing in the real world. Now, the joy is you can make money in a bear market with market neutral, which people love as much as they hate, the opposite. So it is a two-edged sword. But clearly we're getting the wrong edge of the sword here. We're both having bad performance in what we believe in, and we're getting no lift from the market. And what was a really weird conversation is it was very tense. And he kept saying, I really believe you guys are good at long-only management, but not market neutral. And I kept saying, that's because the market's up. We might be great at both of these. That's my position. We might suck at both of these, but we're not doing anything really different. And he was not a stupid guy either. It was clear he was just kind of mad. And I found out afterwards, and everyone in this business goes through this at some time, he never wanted to invest in us, but his superiors really liked us. So he was actually locked up in so my thesis that locked up investors can get mad. People who are free to leave might be disappointed, or they might double down. We have some great investors who do that, but they tend not to be contentious meetings. Yeah. If you tell someone you can't leave, you can have a contentious meeting. And I didn't know I was in that meeting. Right. So I was thinking, this guy's smart and he keeps pushing on these odd. So my cognitive dissonance was finally solved.
If you then you're not going to have as much angst on the client side. What's it done to your organization?
I have a lot of angst on the client side, but go on.
What's it done to your organization internally when you go through one of these periods of time where you're just out of favor?
Some things are real harmful. Some things are tempering, where you get stronger from it. That sounds like a cliche. That which does not kill you makes you stronger is almost always true. It is not always true. Something that leaves you maimed, bloody, and hated by everyone for the next century, but didn't quite kill you, that's not good. But directionally, you do find out who your friends are, both internally and externally. You find out, again, I don't want to use true believer like a blind believer just based on faith. I think we do go re-examine these things, try to reprove them to ourselves, have the appropriate amount of cynicism. But after that, you do find out both externally with clients and internally who really get it to the extent you get it. You might be wrong. I don't believe we're wrong, of course, but I don't mean this arrogantly when I say get it, but who gets the thesis here, knows what it's going to look like on occasion, knows the world can go crazy. You lose assets in this industry. I have written about this. I wrote a piece in 2013. I could be wrong on the year, but I could be off by about 15 years on my year estimates at this point. But it was a good period for us because you're not allowed to write this piece in a bad period. In a bad period, certain things you write are just taken as excuses. I wrote a piece about 3 to 5 year evaluation periods saying that they're what I call mildly backwards. They're not massively backwards, or else we'd have a very high sharp trading strategy, reversing this. But the world, every investment committee is geared to look at 3 to 5 year outliers. Barring a long-term capital, we lost all the money last month. They look at the longer term, And and organizations, particularly committees. I've served on many investment committees, and I will include the ones I'm on. This is not me being nasty. That you can take 10 investment geniuses, put them on an investing committee, and get an investing idiot pretty easily. So getting rid of what's causing pain, I have no great cure for this. I'm not going to suddenly say, don't look at 3 to 5 year periods. I'm a little jealous of my friends in private equity who basically have that deal.
Yep.
I've said many times that we're fine. You know, if we're private equity, I'm like, yeah, it's been a little rough now, but it'll work out. And no, and it kind of ends there. But I do think it is super rough. Money chases performance. Despite my one attempt in the Financial Analyst Journal to argue it should be mildly the opposite, not massively. I'm not saying triple up when something's down, but if you've believed in something before, your bias, even if it's a small one, should be to do more of it when it's had a bad 3 to 5 years, and do less of it when it's done great. You want to temper that with looking at valuations. Like I said, just because value did poorly in the early 2010s didn't make it cheap. But I think the world is mildly backwards, but I've not convinced the world. I think we suffer less than some, because I think we have a lot of great clients who do get the systematic nature of the process, who do know we've stared into this abyss several times before and stuck to our guns and been right. But you lose assets when you lose money, and you gain assets when you make money. And that makes our business, not AQR by any means in particular, but our business extremely pro-cyclical. You can't not add people when times are good and assets are going up, because the cardinal sin would be caught without enough resources to manage the money you manage. And then we try harder to cushion it on the downside. But the most painful part of a drawdown is not losing assets. It's not making less money. It's having to shrink in terms of people. And I have no great words of wisdom. These are some agonizing decisions. We care about every one. We try to minimize the pain as much as possible. But nobody in asset management who has a really good period followed by a really bad period, even if they've made money for 25 years, doesn't have this as some aspect of what they do. Again, I can whine about it. I can shed a tear over it, but it is connected with markets perhaps not being perfectly rational. Again, it's a case of me being a hypocrite. I want markets to be irrational enough that we get great opportunities, but I want every investor in us to be stone cold Vulcan. And it just doesn't work that way. Yeah. And that leads to our entire business being more pro-cyclical than I think it should be. But if I had a cure for that, I would have instituted it long ago.
Yeah. Cliff, we don't have a whole lot of time left, so I do want to ask you one last closing question, which is
usually a doozy.
Yeah. What life lesson have you learned that you wish you knew a lot earlier in your life?
Well, I already mentioned one. That no matter who you are, no matter what you think you've done, no matter how wonderful you think you are, luck is a big part of what got you where you are, on the downside or the upside. There are differences between people. I'm not throwing the meritocracy out the window, but until you internalize that, I don't think you're even fully an adult. And I clearly was not fully an adult at some point. I won't say how far back in the past. We've talked about it the whole time, so this is a little redundant, but each of these 3 kind of tough periods we've been through, and this one in particular, has reinforced with me how hard this business is. You look at a back test, and let's ignore all the critiques of back tests. That it may be overfit, maybe the world has changed. Imagine you look at a back test and go, no, it's not a money machine. It's not the Renaissance Medallion Fund. It's a 0.6 Sharpe ratio long-term. And I think it's true. And then you look at the drawdowns for this back test. In theory, you'll say, oh, yeah, that's probably stunk. But yeah, of course we'd stick with that. And of course our clients would stick with that. And that's with the hindsight of kind of knowing it works out. When you're having a bad drawdown, I think all logic says it will work out. But It is much, much harder. We look at things, even today, people look at charts of value investing in the tech bubble and are kind of blasé. Well, it was horrible, but it came right back fairly quickly. And that almost ended my career, or at least would have had my career in a different form before it got going. So again, this is tied into why these opportunities remain. That's maybe if I have one obnoxiously repetitive theme of this talk, is that you can't have one without the other. But this idea that it is far harder to stick with a strategy that you believe in your heart and soul, has proven itself, that you think you've tested, that you think you've been open-minded about. It is still way harder than you would imagine when you start out in this business. You're nodding like you've had some experience with that too.
On that happy thought, I think we may have to close it.
It's not an unhappy thought, because again, markets would not present these opportunities if they didn't make it super hard to stick with them. But it is a bit of a paradox that you got to be miserable to make money.
Absolutely. Cliff, thanks so much for taking time to do this.
This was great, Ted. Thank you. Thank everyone else.